Today, I'm going to give you a little bit of an overview on how we're seeing the economy, the Australian economy and the global economy, and then touch a little bit on the ETF, which was mentioned before. So thank you very much for your time this morning. Firstly, I'd like to highlight, I guess, Western Asset's view of the world. I come here with a title, Dark Clouds Remain. It's pretty ominous. It sounds pretty gloomy out there, but I'd say overall our view of the Australian economy and the global economy more broadly is pretty sanguine. We're pretty positive on the world relative to where market pricing is. So if we look to Australia, we think the economy remains well supported by infrastructure spend and by very strong labour market. But there's definitely risks out there. When we look globally, we think central banks' number one objective will remain to keep the economy ticking along. Yes, we're in for a lower growth world, lower inflation. It's not really going anywhere anytime quickly, but we're not in the camp where I guess we see a recession coming in the US or anything like that imminently. That said, there's risks out there, and we're calling this risk at the moment dark clouds. And the reason why we're calling those is because there's a real potential that any one of these risks could rain on the Australian economy or the global economy more broadly. So the challenging thing about the risks that are out there at the moment is, one, they're very, very hard to quantify the probability that they will actually turn into a storm and start to impact the economy and the markets more broadly. And then secondly, trying to quantify what the actual magnitude of the impact on markets will be is also really challenging. So our view is remain diversified and remain liquid, so you can take up these opportunities as they come about, because people will get overly pessimistic and overly optimistic on both sides of this coin. And we believe that having a little bit of diversification in your portfolio for that is important, and that's how we're running our portfolio. So what are the dark clouds that we're looking at and concerned about? Look, the ones in Australia are pretty obvious. You would have read about it in the newspaper every other day at the moment. Look, credit conditions remain very constrained. There's no doubt that, while we're seeing some of the banks come out and talk up a pretty big game at the moment, what we're actually seeing come through to the actual network and lending standards is a bit of a different story. Credit conditions remain constrained. This was a deliberate ploy by APRA. We all remember when people were concerned about a housing bubble. Now we're concerned about it rolling over a little bit too much. So at the moment, that is most acutely felt in house pricing, but there is a real probability that could flow through via the wealth effect and hit the consumer more broadly. We think it will at a moderate level, but not necessarily at a level where the housing correction becomes a disorderly house correction and really starts to impact the economy to what would be, a significant extent where we would see a recessionary type environment. The other one in Australia, and this is where it gets again very hard to quantify what will happen here, but there's political changes afoot, or potential political changes afoot, and policy changes that come with that. And people are talking about the franking credit issue, also the tax rules around housing or housing investment. And the other one I think is a pretty big one, and probably the biggest one to the condition or the economic condition that we have here in Australia is immigration. Immigration has hidden a lot of issues in this economy, and we've had a bit of a population-based recession here in Australia, where immigration has hidden that lack of growth here in Australia. When I look to the global world, geopolitical risks are at the forefront. Look, we've had a little bit of one or two, steps forward in this space, and you spoke about the trade earlier. I'm not sure who that was, but spoke about another step forward in the China-US trade negotiations. But look, at the end of the day, there's been no resolution. There's no resolution in Brexit. There's no resolution in the political uncertainty in Europe. There are a lot of risks out there, and while we're of the view that we will probably muddle through these different political risks, again, the probability that one of them comes back to bite us, it's real, and actually quantifying that is very, very challenging. So again, remain diversified, because these things can pop up overnight and all of a sudden really have a large impact on your portfolio. The other thing, and look, we're of the view that central banks will remain very accommodative, but at the end of the day, central bankers are people, and as we've all seen clearly, they make mistakes, whether it's in their action or in their rhetoric. So be very mindful that central banks are going to cause volatility. We saw that from the Fed, and the Fed's walked back now, and they've given us a bit of guidance on what's going to happen with the balance sheet, which is positive. But again, they could stuff that up very quickly by coming out and getting a little bit too handsy with the economy. And from our opinion, the best way to ruin any economic growth cycle is the Fed can come out and kill it overnight. That is the most likely path that it goes down. At the moment, we're broadly positive that Powell will be I guess, a little bit more pragmatic. When we look to Europe, there's a lot of concerns and people are still quite unsure about what's happening over there. Yes, they've extended their asset purchasing, which is great for the time being, but what is the next, I guess, issue that comes out of there? And they seem to be pretty frequent. Then I guess if we look to more broadly, some of the things that we look at quite closely, looking at the US yield curve, it was inverted there for a little while. It's kind of, if you look at the cash versus 10, it's not inverted at the moment, given the sell-off we saw in yields overnight. But we call it at Western the Cassandra of indicators. It's the one indicator that every economic cycle in the US, it's predicted the recession, but every economic cycle people have denied it and ignored it. So it's kind of the Cassandra of economic indicators. So we're watching that quite closely, not necessarily saying it's going to, I guess, result in a recession now, but it can be a bit of a self-fulfilling prophecy, that one. Sorry, so I guess our view is, remain liquid and remain defensive, at least in some component of your portfolio. Obviously, you don't want to put all of your eggs in your defensive component, otherwise you're not going to make your clients any money, but we would suggest having something in that portfolio for that, I guess, scenario where things do go a little bit pear-shaped. And one way you can do that is via BNDS, which is a listed version of our fixed income strategy that we've been running now for over 30 years. So look, it's Australia's first active fixed income ETF, which we think is very positive. We're not a huge fan of passive fixed income, given the flaws within those benchmarks. It gives you access to our portfolio, which has outperformed the benchmark now for a very long time, over 1% after fees over the past 10 years. It comes at a pretty attractive cost of 42 basis points, and if it's distributed by both Legg Mason and Western Asset, with very strong ratings and awards for Western Asset across the board. So thinking about our portfolio and how we're positioned, given the scenario that we've painted, as I said, we're broadly positive. And when we look at, I guess, corporate Australia, again, from a debt perspective, we're quite positive indeed. If we look at net debt levels, so debt less cash versus earnings, Australia is in a better position today than it was in 2017 and 2016. So from a probability that we're going to get our money paid back at the end of the day in our coupons every quarter, we're in a better position now than we were at any stage in recent times. So we're quite happy to be overweight corporate credit, but what I would say is be very mindful about where you're holding that. There's a big difference between investment grade, short-dated Australian paper and high-yield bank loans or anything like that. Not necessarily saying that I'm overly negative those places, but just be mindful that they're not going to offer you very defensive attributes if we were to see a bit of a sell-off, and that's what we really saw in, I guess, Q4 last year, where we saw a bit of a sell-off in credit markets, and this type of strategy rallied quite strongly. We're quite underweight from a government perspective. I guess that's our other big position. But what I would say is what we're doing is we're underweight the front end of the yield curve. We don't really think you're getting paid to play at the front end of the yield curve from a government perspective. A 2-year government bond actually doesn't offer you that much by way of yield, nor does it offer you a lot of rally in a risk-off market environment. The price actually remains pretty stable, given it's going to pull to par pretty quickly. So where we're overweighting the government bond curve is out the back end. So 20, 30-year government bonds, they tend to give you the biggest kicker in a risk-off market environment, and that's our ballast in our portfolio, and that's which we think is giving us that real diversification across the portfolio. That said, overall, we're a little bit short on the duration front, especially given where yields have rallied to over the last few weeks. Looking at the overall quality of the portfolio, look, we maintain a very, very high quality in this portfolio. So while we are overweight that credit, it's a real high quality bias, and where we are taking triple Bs tends to be in the very defensive end of our space. So thinking about infrastructure, transportation, these sorts of companies that run a triple B balance sheet in order to support a return on equity. I mean, we're very comfortable around them. Some of them are such as Port of Melbourne. It's a 50-year contract there with a 30-year non-compete, so you can't build another port in Victoria and underprice that particular entity. So we're very happy to lend to them over the next 5 or 7 years. That's a very stable investment from our perspective, and happy to reach down into the triple B space. But more broadly, we've got a AA credit rating versus the benchmark at AA+, and just remain pretty conservative around that position as well. So before I move on to questions, mindful of your time this morning, look, that's the performance of the headline strategy, which we've been running in the unlisted form now. And as you can see, over the past 10 years, we've added a little over 1% over the benchmark after fees, which we're quite pleased about. And it's done its job quite well. The other thing I'd probably point to on the other page, I didn't point to the running yield on the fund, which is sitting a little bit above 2.5%. But the reality of a diversified fixed income fund, it's a lot more than just a yield that you see on the number. If we look over the past decade, there's only been 1 year where you haven't received substantially more than that running yield on the fund. It's about the further attributes that are added to the portfolio from a defensive nature.